Hi, this is Randy Finney with Right Side of the Chart, and this is a mid to latest session update for Friday, March 21st, 2025. I'm starting this one right after I fired off that VIX post. I just want to kind of convey on my thoughts, trading plan, strategies. The goal in trading is to make money, but we'll quote I almost called him the late great Warren Buffett. I'm sorry about that. The great Warren Buffett. He says rule number one is don't lose money. Rule number two, never forget rule number one. So that's, big part of it. I've always said this over the years. If you followed me, you heard me say this. I've never had a problem making money. I've made money returns that would make most people in hedge funds, even some of the greatest pros out there make their heads spin. But then, given a lot of that money back over the years. And as time went on, I've learned, to give back a little less, ratchet up the profits, take my position sizes down, especially when the clarity on the charts or whatever it is I'm trading. I'm kind of speaking to the broad market now, but sometimes I'm hyper focused on natural gas or crude oil or gold or some other obscure commodity, or even an individual stock. But as far as trading goes, especially in the trading the broad markets, one thing I'll tell you: profits ebb and flow, and there's periods where, again, I'm speaking. This is decades of trading where. Most of my gains for the year, the bulk are made in these short bursts when you have volatility expand around pivot points, whether it's longs or shorts. And this year has been a very good year. Late last week or so, we've been grinding around. So obviously, at least for me, things have kind of slowed down. So I'm kind of in, just being patient, just waiting for the market to pick its next direction. Still position long, looking for that bounce. But as I told you today, and this is again where it comes back to risk management, weekend's coming. So you have, let's just say, again, you may be on the other side of the trade of me right now. You may be short the equity markets. And I'm talking net short. You can have long, different positions. That's one way to hedge. I talk all the time about hedges. Most people think of hedges as if you're long the S&P 500, you buy a put on it. And if you're short, you buy a call. To me, I don't do that. It's a waste of money. The only person making money there is my broker. I don't like a market neutral hedge. There's fees and expenses involved in the options contract. And even worse is those that, are long QQQ and then turn around and buy, SQQQ or one of the inverses. Again, your broker's happy, you're making money, but if you don't have that much confidence, get out of the market. So I like those indirect hedges. We've had a great time over the last year using strategically and tactically long and short treasury bonds often, and it worked out. A lot of those trades worked out very well. And what I mean by that indirect hedges is something that, and again, you have to be, and I speak to it each time, you want something that's either positively or inversely correlated to the equity markets. If it's positively correlated, you want to, go the other way, long or short. And there are times that my clarity on the charts on, let's say, treasuries is very, the outlook's very clear. If I can make a strong bullish case, and the whole point being there, if treasury bonds rally, it means rates go down and usually stocks go up. But as I've said lately, you haven't seen a lot of treasury bond trades from me or analysis, and I've told you because the charts just aren't that clear right now. So I'm not going to waste time, your time or mine, covering charts of something that I don't plan to trade or don't have a strong opinion on. However, I threw out this idea today. This is certainly probably a closer indirect hedge. And again, indirect hedge, if a direct hedge is your short QQQ, you buy something like a call or something, or you go long QQQ or one of the derivatives. Or you could even be short QQQ and then long the best looking Mag 8, Apple, Tesla, Meta, whatever they are. That's also a way to more of a not so indirect, but not a direct hedge. Now, a VIX hedge is indirect, but the correlation in the stock market, you can see here's our last VIX trade, or current VIX trade, really, it's one and the same. Shared my thoughts there. We hit, first target. Reason I list multiple targets, which you can find in the FAQ page on the right side of the chart, is because each level upon the initial tag, when the trade's even first laid out, that's where I expect the first tradable reaction to happen. And so as an active trader, you can, book profits and or reverse, turn down and go short. And so instead of just being up, making 42% or 50% or whatever it was on VIXY, turn around and short it and gain part of or all of that 20% pullback. Now, again, that's active trading. As far as the hedge now, as I laid out, if you have, again, let's just go off this, that you're going net long home into the weekend. Again, there's no way you or I or anybody can control what happens over the weekend, extra days overnight risk. But, if the market gaps up big on Monday, your equity positions go up, and VIX is likely to fall. But as I said in that post at the end in summary, we're getting down close to the bottom of the range. I know this is VIXY, it doesn't track the VIX exactly, it's short-term futures. But you can see that the downside's starting to get minimal. So just like I was saying a week ago, just over a week ago, that I didn't think the RR to add new short positions was favorable in the stock market, and you certainly didn't go anywhere had you tried to. This was right here, or up a little bit. Now it could have gone the other way, and I wouldn't have been wrong by saying that. I just said the risk reward. In other words, we were so oversold, and I pointed that out before. And usually, when you get that oversold, there's a oversold bounce to come, and so I'm viewing that very similar right now in VIXY. That if the market does pop and rally next week, and let's just say hypothetically we go in to hit those bounce targets, I have about 7% off last week's lows in QQQ. Yeah, we can go down, but again, there's how much downside is left in the VIX, relatively speaking. Remember, when I pull this little measuring tool and you see the pop-up box on the left, to the recent lows, that's almost 17%. But you don't take as much in the VIX as you take in QQQ, not even close. And I wanted to talk on that. Again, I know I'm speaking to a lot of new folks coming in the site, new at trading, even those that have been here a while, and might tend to forget these things. It's something years ago I nicknamed the know your security rule. If you're going to trade something, know what you're trading, know it like the back of your hand. In other words, know if you're trading a stock, what's its history of gapping around earnings. Some stocks manage earnings so well there's no surprises, and they barely can do a 2-3% gap historically. And then you trade things like Tesla and even Apple, largest company in the world at most points in time, and it can gap up easily up or down 10%. So you need to know that going into earnings, that you're risking at least double digit gain or loss. And now also I wanted to speak to on VIXY. So I talk always, kind of frame things in an RR perspective. Is it worth a trade if the risk reward isn't favorable? Then you don't want to. So if you short VIX, here was an example. And we were long off that low, just like we were long off this low. And here was a pullback right there. And I'm going to measure it out. I'm going to turn off the lines just so I can measure it, kind of give you an idea. So this one was about 20% that we just had into the recent lows. That one was about 13%, and then the VIX perked up after that. But I want to show you just to quantify, so to help you get an idea of how much the VIX can move when it wants to move, when it wakes up, so to speak. So there's a red candle, so I grabbed the bottom of that candle, and that's where it closed that day. The following day, if you were in it, I'm just going to go to the high, because you would have been riding this out had you been shorting the VIX, and a lot of people would have, because it would just come down. And in a single day from where it opened up, it gapped up, and it was as high as 24.35% that day. Here's another day. We closed here at the high. You were up 12.66. We closed at the top of that green candle. If I can grab it, I have to turn the lines off again, or I'm going to move the line. And I'm just trying to quantify for you again. There's 27%, right? And then if you thought, I'm going to ride it out and it's going to come down, VIX, that's too much, and you held your short, if you were, we were long that time. Don't get me wrong, we were long, predicted this move. We hit the maximum original target I gave you right up there. It was up 79% in 2 days. So that's enough right there. I just showed you that there's a period in the not so distant past where in one. Let me see if I grab from right here where we close, or let's do the 3-day right there. From there to there, 100%. Okay, so now you know the nature of the VIX. And when she perks up, and she's perked up recently, those big moves, they don't come off the low. I've never seen the VIX, hit a multi-year or multi-month low like that and then do it. It wakes up first, and it's certainly woken up. So I just wanted to point that out there. And again, so The risk, if something happens over the weekend that's not good for the market and there's a big gap down in the market, especially guys, if you don't trade futures, because futures Sunday night, the VIX futures will start trading along with the index futures, and you can get out. You can use stop loss orders. Not if you're trading the ETFs. This thing, I don't believe, even if your broker has Sunday evening or early hour session trading, this guy's too illiquid to try to move in and out of. So you're going to wake up like you did back here that day. That was a gap of about where did we open that day? We opened at 53.80, yeah, somewhere around the bottom there, but it was still a sizable gap, and there was an even bigger gap right there. So all right, so that's what the VIX can do, and you can see this gap was massive. That was your open was up there. That was a gap of 43%. It would have just wiped out most retail traders had you put too much. Okay, so I don't want to beat a dead horse here. I just want to say that you don't put, if you're trying to hedge the SPY or QQQ or whatever it is, you don't put the same dollar amount in the VIX as you do into your QQQ. You don't need as much. It tends to move up and down more in percentage terms. What that number is kind of depends on conditions, but let's at bare minimum, it's cut it down in half. In other words, put half what you would in the and again, it depends how hedged you want to be. If you're more confident the market's going to bounce next week, you can take a partial hedge. That's what I told you. My plan was start scaling back in long here. There's a 60-minute chart of VIXY. You've got this little wedge, like I showed you on the futures, little bullish falling wedge type pattern. We're back here to the support level. And I clarified for you in that post that this is the same, those two reaction highs. That was my 25 whatever target on the VIX futures. We were long here at the low. I've been highlighting here, laid out as a trade idea. So we milked every penny of that. But again, the futures roll, and the VIX, just like natural gas, when you roll, because it's such a volatile thing, the futures vary quite a bit. So the price levels change. In other words, it's just as the name implies. You can trade the VIX, you can trade VIX futures, you can trade the near month, the Aprils, you can go out to the Junes, whatever you want. The VIXY, that one I've been sharing, are the near month VIX futures. That's what it tracks. You can see the bullish falling wedge with positive divergence right there. If it wants to continue a little lower, I just think you'll start to see compression. If the market rallies next week, the VIX probably goes down. It usually does, but I think that the rate of descent will be lower than it was here, right? So I think we, sidestepped or milked, good part of that I did, and told you to reverse there, and that's it. So take it, don't take it, just throwing out an idea. It's objective. And again, I'll have more clarity next week. And as I said in that post, then I'll decide to either add or subtract to that position, meaning increase my VIX long or close it out or reduce it. But that lets me go, again, I may change before. It's only 221. I'll see what happens by the close today. Decide how much I want to bring home. Okay, let's look at the spot VIX. This is VIX spot VIX. Remember, you can't buy the spot VIX. It's an index created with a methodology. You can read about how it works. So what you can do is trade what we call derivatives on the VIX, instruments that attempt to track a price of another thing through a derivative, such as VIX futures, options on those VIX futures, or the ETFs that track and hold, buy VIX futures. And so you had this purpley trading range here, and we were long here. I've thrown it out several times off these divergent lows, most recently this one, including that one back there. We had a trade set up on the VIX. My targets disappeared on VIX. Oh no, it was VIXY because it split. It did one of its usual reverse splits. Over time, the VIX ETFs will decay. Let me repeat this. If you try to buy and hold that, long term, they're going to lose money over time because they have the expenses and costs of rolling futures, contango, all that other good stuff. And anyway, I think that's what it's called on the VIX futures. I don't know if that's only on commodities, but this is the spot VIX. Here, let me look at the weekly chart. So this is kind of the big picture, and this aligns with my big picture on the stock market, calling for a much, much bigger drop over time, whether we bounce next week or not, whether the bounce is over or not. We certainly did bounce this week. like I said, it was like a wet, heavy blanket was on the market, which, kind of shows it's not a good sign at all. Now, that blanket could be lifted today, later in the final hour, or next week, or not. And if it doesn't, let me tell you what happened. Let me go back. Let me go back before I forget. I'll loop back to this. So let's talk about the what I talked about last week. So one reason that I told you for covering up shorts and going long, one but not the only reason, was the oversold condition of the market. I told you the last two times in recent years we were right here and there. And you can clearly see, what did you want to do back then? Did you want to start shorting or add to your shorts or stay short, or did you want to turn around and reverse it? Now, I also said this was a little bit different because we were still above the primary uptrend line in the 200-day moving averages. In fact, that one was a nice pullback to the 200s. And that one we did actually cover and went long for not just a little short-term bounce, but a decent trade. So this one's a little different in nature because now we've broken the trend line, we broke the 200s, we came out of that trading range, which I was harping on for weeks and months, how important that is and how powerful. And the next, once we had a definitive break in either direction, particularly the downside, that would determine the next tradable trend. And I still maintain that. Why would I change what I said before it happened? If it did happen, everything's happened as I figured. So yes, nothing's changed there. Now, where I'm going with this is, so guess what happened last week? We bounced. Did we bounce as much as I thought we could to my max target? No. But guess what? We certainly worked off this. We are no longer oversold. So there are two ways when a security becomes oversold. There's two ways to work off those oversold conditions, or a combination of those two. It's what I call a reaction. I talk about reactions. When you hit a price target or support level, reaction I define as one of two things or a combination thereof. So the support level is a floor. If you drop a golf ball on the floor, it's going to bounce hard. That's a reaction in price. If you drop a hacky sack on the floor, it's going to stop. That's a reaction in time. And of course, you can have a combination. This is more of a combination of the two. More so in time, but it's worked off those oversold conditions, opening the door should the market want now to have another flush out, especially considering the longer term, more powerful sell signals. Just like back here, there was a first time when the bear market started in 2020, early 2022, we got oversold. Things got a little ahead of itself and wanted to reset. And after a reset, which happened to be a kickback of the 200s, then the next leg down became oversold again, had positive divergence, and we had a better bounce. So that would be an ideal scenario, seeing the next leg down, maybe hit my next targets, put in positive divergence, and then set the stage for a double-digit bounce. Right now, I haven't been calling for a double-digit bounce. I said maximum about 7%. That may change, but that's still, and again, I can't reiterate or impress that on a maximum. I had shallower targets as well, and so this is where we're at here on that. So let me go back to the VIX. All right, with that being said, you kind of get what I'm saying. We've worked off the overbought conditions, oversold. And remember, as I said before, quite a bit in the last few analysis, we haven't even become close to being oversold on the weekly chart. In bear markets, if that's what this is, I think it has the potential to be the start of a new bear market with a lot more downside to come. You get oversold. That's where you want to take notice on the weekly chart. We're not even close to oversold. So as bad as you think this is or feels, if you're long, you were out on leverage, you had a lot of chock full of tech stocks in your 401k or your accounts, and you're saying, oh no, the market, yeah man, Tesla's on sale and Microsoft and Apple, they're bargains. No, just look where they came from. Look how overbought they got on the weekly chart. Look how insanely bullish sentiment got. Everybody telling you it's not a bubble. That's when you know it's a bubble, when just about everybody on TV saying crypto is not a bubble and AI is not a bubble. Then it's a bubble. I think it's a bubble. All right, but either way, that's where we're at. So it leaves the door open if we want to have a quick swoon down, and that's again where if you're trying to game a bounce, I wish I had stronger convictions. If I did, I'd tell you. You know me. I would tell you I'm going heavy short or heavy long into the weekend. Nope, I'm hedging up. To close to a market neutral position, and I might even at the end go home net short. Really, I don't know. This whole wet blanket thing, they just can't get any type of rally going. And again, maybe that ends. Maybe it takes a headline to come through to spark a nice rally. I made it, a case, and that's still my preferred scenario, a little more upside, but it's not. You can hear my voice, and I'll say it with the words. My convictions aren't that strong. So there it is. What else did I want to cover for you? Let's do it this way. Let me turn off all the lines, go through my Mag 7 or Mag 8 stocks, and just real quickly show you. Apple, way below its 200 moving averages. Last time it was back here. But overall, if you go back historically, and you can see it on a weekly chart, put up 40-period moving averages, you see they do a very good job of defining bull and bear markets. This was a bear market, make no mistake about it, for Apple. And it spent most of the time below the 40 weeks. But we can go through them all here. I'll stay on this weekly chart. Microsoft. Clearly, you don't have to squint to see it taking out the 200s now. This was a bear market. In a bull market, you're above the 200s. And in a bear market, you break below, and then you short rallies back to them. Boom, boom, boom. And then once they clearly recover, you buy pullbacks to it. It's so simple and so freaking effective that it's amazing that others don't. But again, the problem is if you're doing just one single stock, that one sometimes will give you a little whipsaw. So again, that's why I do all of them. You look at it collectively, and that's what I'm doing for you right now. So Apple way below. That's a weekly chart. 1 week, one fell swoop. You don't have to blink to see it. It's not going to recover the 200s this week. Zero chance. There's an hour and a half left in the trading day. Too much real estate between where we are and then where that is. Microsoft has no chance of recovering the 200s this week. Will clearly close below them. NVIDIA. Back testing, so it's going to still blow, and will most likely close on a back test of the 200 exponential with the 200 simple a little above that. So there's the top three right there. I could stop really tell you the top three components are below their 200-day moving averages, and unless they all giddy up and get back above, it increases the odds that we've made a major trend change, i.e. from bull to bear trend. Amazon clearly below. That was a 1 week spike. Most of the other Mag 7, I covered it at the time. That was the August 5th lows, and I allowed the Amazon, I acknowledge it was through there, but all the others, majority were on their 200s and bounced. And so Amazon, that just proved to be a outlier. And now it's below it. So now I'm on number 4. All 4 are below the 200-day moving averages. I go to Alphabet, 5th largest holding. You don't have to blink or squint to see it. Clearly below it. Stick save right here. I'm printed right back on the 200s. And you can see, again, look at how well those blue and red lines, the 200 simple and exponential, have defined bull and bear markets. That was COVID. That was a bear market. This was a bear market. We were below them. This was a bull market. We've been above them. We're below them. Number 5, Meta. Testing is going to close the week on or just above the 200-day moving averages. Last time it hit them was right there. Last time it took them out before that was right here. Back tested, couldn't get back above them, and the bottom fell out of the stock. Broadcom on the 200, so that's and then the last of the Mag 8, Tesla, clearly below the 200. So there it is. Collectively, you have the majority of stocks below there. Therefore, it's hard to get too bullish for more than anything but a short-term bounce. Market had every opportunity to bounce this week, didn't. So I'm not. I'm a little less optimistic heading into the next week as I was heading into this week that we were going to bounce. We did bounce this week, but again, it was just a muted kind of bear market-ish dead cat bounce thing. So that's what that is. All right. What else? And that's, we're still in that T4 zone on Tesla from these targets back here. T1, 2, 3, 4, 5, 6 down there. I'm just going to wrap up here on IWM. I don't want to get sidetracked and go into too many other things out there. Remember, the risk on assets, it's your Bitcoin, and a lot of the stuff we shorted on the way down that are bouncing, Carvana and all that, I still have deeper downside targets on Bitcoin and everything else. And it's a matter of, and so same with that correlation on the market. If your market bounces, they bounce, and the market goes down, they go down. Here's IWM. Hit that first price target. I already covered it this morning, and so far there's no buyer stepping in here at support. Again, to be continued next week. PPOs cross back above the 0 line here. That often delineates bull and bear trends. Bearish when you're down below. bullish when you're above, but we've been in a bear trend for a while. So, and that's the other thing about these divergences. They in a bull trend, in a bull market, divergent lows on the 60-minute chart usually play out for rallies to new highs. In a bear market, they don't. They tend to not play out. They tend to fall shy of their measured target, their projected target based on the pattern. And they usually get sold into just as they start looking good. So I'm going to wrap it up here. That's it. You guys have the levels. There's a lot of uncertainty in the markets, both on the technicals, i.e. the charts right now. I gave you a big picture near term. And then also, of course, we've never seen such uncertainty in the political landscape. And the macro, with things changing too. Now, let's not forget, I've kind of laid off it for a while, but I was covering the Fed, which is a St. Louis Federal Reserve site, showing you everything now they're talking about. They were dismissing, kind of suppressing that stuff. I talked about delinquencies surging in banks, credit, consumers 30 and 60 days behind on credit card and auto loans, and showing you the consumer was breaking. CNBC kind of squashed that, watch when the analysts come out. They weren't talking much about that, just that everything was hunky-dory, no recession in sight for 2024. At best, maybe 2025, 2025, no recession in sight. I'm talking in the beginning of the year. And then boom, as I promised, nothing will change sentiment in the words coming out of those analysts and economists' mouth quicker than a 10% drop in the market. That's where, again, I think I see things different. To me, it's crystal clear, and I said it before. For those wondering, I was saying it up here when we're back here at all-time highs. How possibly, Randy? I'm speaking metaphorically. If you're saying how possibly, Randy, we're going to drop 52%. They're saying no recession this year. It's the simple fact that the technicals, when the charts break down, stocks go down for technical reasons that I cite all day long, day in, day out. Then that causes the drop. Then the wealth effect, which again has never been so pronounced. So just keep that in mind. Today, the wealth effect, especially the stock market component, I think is greater at any point in history. I know that because we have a higher participation of markets participants. Last year they implemented the new rules where companies automatically enroll employees in 401ks. You didn't have that automatic enrollment before. So you had a lot of people, money going in the stock market. Again, we know where the bubble started. We know with crypto and then the meme stocks, AMC, GameStop. We know that when COVID hit, all of a sudden the government was cramming cash down people's throats, sending out checks, whether they needed it or not. Everyone got to stay at home, and then it spurred a new generation of financial wizards. They thought they were, the game, what do they call it, the Reddit traders, and what is all the little Robinhood, all those little online trade on your phone kind of things, and all ships are lifting a rising tide. And so that money now, that was part of the bubble that contributed to this this big rise in the market. And therefore, all I'm trying to say is I cannot guarantee we're going to go down to any of my target. I can't guarantee we're going to go any lower. But if it does happen, what I can all but guarantee you, it's an incremental but accelerating thing the impact it has on the wealth effect. So if you just, again, visit my targets here and just say that, let's say we get down to T3. Now you're down the entire, now I'm using the NASDAQ 100 as my proxy, 23%. Right now it's simply about a 12% drop in the NASDAQ 100, 12, 13%. You go down here, you're talking a 30% wipeout. Let's go to SPY here. We'll play around with SPY, my targets. My targets on SPY down here, again, calling for a drop of, before all said and done, about 30, nope, not 32. That's just not all the way to my final target, T7, 43% drop. And so far, I think it's about a 10% drop. They're calling, say SPY drop 10%. And you get down to T2, my next target here. Now you're down almost 20%. That's going to have a huge impact on the wealth effect. So, and you can see actually SPY this week. You know what? I missed that, guys. That's funny. I'm glad I'm looking at this. We did backtest the 200s on the S&P 500. Look at that. 1, 2, 3 different days, the 200 exponential. We haven't done it yet on QQQ. So if we get there next week and there's a little more upside and we get to 200s, that would be an objective shorting point for the NASDAQ 100. But we may never get there. Remember, tech was very heavy and bloated and overowned and overloved. And so far, they keep trying to buy these Mag 7, Mag 8 stocks, and every time they just start going up, they get sold into. So, all right, let's not make any more of it. Let's look at next week. So, we'll see where we're at. And we still have the potential, when you look at the weekly charts, potential bear flag continuation patterns consisting of a flagpole, flagging type action. That is the, if things get ugly scenario. SPY, I think you'd view it better on the daily chart and turn off all the lines here and just draw it out. And you again, flagpole and impulsive move down, followed by a level of consolidation on declining volume. And then this flag, if you do draw it that way, has broken down too. And we'll see where we close today, but that would be your flag right there. Flagpole. Measure target is the distance of the flagpole to the lowest part of the flag added to the highest part. I'm just eyeballing it there, guys. And that would take you down there. Turn on my levels here. My next, remember, T1 was already hit way back here. It's a continuation of the same price targets I laid out back in the middle of last year. We made a marginal new and still divergent high, so nothing changed in the technical posture of the charts. Therefore, my targets I still maintain from before. All right. So let's see what happens in the final hour and 20 minutes of trading today. Can we get a rally? Can we get to the next bounce targets? That would be nice to if you plan to lighten up for the weekend. You can see QQQ is really just, this is the level we've been pushing against. We need to pop that level. And I think I have it clear on the 15-minute charts. Yeah, I do. This is kind of the level right there, the magic number. Now, this was the magic number. Pop, got sold into. They tested that high again. That now establishes that is the level to beat or break in order to send us up to the next potential price targets or resistance levels. And then again, gift would be if we get all the way back to that trading range here, that big boxed in, should be a box right there, which coincides with my maximum bounce target, I believe. All right, let me wrap it up here. This has been Randy Finney with Right Side of the Chart. Side note, I will be out of the office all day on maybe a little bit here, possibly in the morning, but Tuesday. I'm going to be out Tuesday and probably won't even, I don't know, maybe back by the end of the day. We'll see. So I will be around Monday, and I'll certainly give you updates there. And if I don't get anything else out to you today, have a great weekend, guys. This has been Randy Finney with Right Side of the Chart.